For today's discussion, we're going to take a look at case study 6, which can be found on page 266 of your textbook. So if you'd like to pause the presentation and go to page 266 and then start it up again once you've found that page, we can carry on. Case study number 6 is about Yoshi Enterprises. The revenue and expense accounts of Yoshi Enterprises are shown below. In year 1, there was revenue of $100,000 and expenses of $75,000. Financial statements were prepared at the end of the fiscal period, and obviously the net income was $25,000. The accountant quit after preparing the statements, and a new accountant began work in the new year. At the end of the second year, the accounts appear as summarized below. We have the year 1 revenue of $100,000 and the year 1 expenses of $75,000. We have the year 2 revenue of $130,000 and year 2 expenses of $90,000. When you combine year 1 and year 2, you have a total of $230,000, and when you combine the expenses of year 1 and year 2, you have a total of $165,000. It looks as though the net income for those 2 years is $65,000. The difference between $230,000 and $165,000. The financial statements are prepared and indicate this net income of $65,000. The owner thought this was too good to be true, and the owner was right. Why is the $65,000 net income figure incorrect? And what is the correct net income for the second year? The books are incorrect because the books were not closed at the end of the first year. The revenue and expense accounts contain data for 2 years. What's the correct net income for the second year? The correct net income for the second year is $130,000 minus $90,000, which gives us $40,000, not $65,000 as indicated earlier. When a new accounting period begins, the revenue and expense accounts should show zero balances, and that was the problem in Yoshi Enterprises. The year 1 revenue and expense accounts were not zeroed out as they should be. They were kept on the books and were part of year 2, which is incorrect. Revenue and expense accounts must only show data for the current accounting period. This allows for the net income calculation to follow the matching principle. The matching principle says revenue for each accounting period is matched with expenses for that accounting period to determine the net income or net loss. Revenue and expense accounts are reduced to zero by a process called closing the books. For this reason, they are known as temporary accounts. Revenue and expense accounts are temporary because they are always zeroed out at the end of the accounting period. They contain information for that period only. Asset, liability, and owner's equity accounts are known as permanent accounts. Their balances are carried forward from one accounting period to another. Their balances are not closed at the end of each accounting period. So what is the purpose of closing the books? We need to close the books to prepare the revenue and expense accounts for the next accounting period. We do this by reducing them to zero. We also update the owner's equity account. So how do we update the owner's equity account? Before the closing entries are prepared, the owner's capital account does not include the net income or net loss or the withdrawals by the owner if there are any. The owner's capital account needs to be adjusted by the net income or the net loss. The closing entries update the capital account in the ledger. Closing entries also decrease the owner's capital account by the amount of the drawings if there are any. The closing entries bring the ledger accounts into agreement with the balance sheet. Let's take a look at a special account called the Income Summary Account, which helps us during this closing of the books. Revenue and expense accounts are closed by transferring their balances to the Income Summary Account. When the revenue and expense accounts have been transferred to the Income Summary Account, the balance of this account is the net income or the net loss. The balance in the Income Summary Account should equal the net income or net loss shown on the worksheet and the income statement. Let's take a look at how this works. We have the sales account, which shows a balance of $20,000. We want to get rid of the $20,000 by doing the opposite. So you can see here in our example, we have the $20,000 that was in the sales account, and in order to zero it out, we have to put a debit of $20,000. So that makes the balance in the Income Summary Account zero. But what happens to this $20,000? When we add this $20,000 to the debit side, we need to do the same somewhere else. And in this case, it's in the Income Summary Account. So what we have to do is we have to do the opposite. So we take the $20,000 and we add it to the Income Summary Account as a credit. So you can see right here, Income Summary has a credit of $20,000. Now, you'll notice that this is exactly the same as what we had in the sales. We had a $20,000 credit. So all we've done is moved the $20,000 from the sales to the Income Summary. We've zeroed out the sales account and we've put it into this temporary Income Summary Account. The same thing happens with the expenses. Expenses have a balance that is a debit balance. In order to zero it out, we have to add the opposite to the expense accounts, which means that we have a zero balance. This expense amount gets transferred to the Income Summary Account, which we see here. So now we have a zero balance in the expense account, and that money has been transferred to the Income Summary Account. The balance remaining in the Income Summary represents our net income in this example, or in other examples it could be a net loss. So right here, this amount is our net income